We found a growth stock, and we are excited to tell you wealth builders all about it. This is Build Wealth Now News, and I'm your host, Billy Bob. And joining me live is our brilliant market analyst, Sarah. Sarah, what do you have for our viewers today?
Thanks, Billy Bob. Great to be here. We've got a hot topic tonight. AppLovin Corporation, ticker APP. This stock has been on fire, up massively over the past year, but it's also pulled back about 28% year to date. Our viewers are asking, is this a buying opportunity, a time to take profits, or should we just sit on our hands? We're going to break it down methodically tonight.
Perfect. And just a quick reminder for our new viewers, we don't give personalized financial advice. Everything we discuss is for educational purposes. Always do your own research or consult a licensed advisor. All right, Sarah, let's start at the beginning. What exactly does AppLovin do? Because I see advertising platform and my eyes glaze over. Help us out.
Great question, Billy Bob. Let me make this simple. Imagine you're a mobile game developer. Say you just launched a new puzzle game. You need two things. One, users to download your game, and two, a way to make money from those users once they're playing. AppLovin is the connective tissue. Their AI-powered platform called Axon does two things simultaneously. First, on the advertiser side, it helps developers like that puzzle game studio find the right users, people likely to download and actually play, through targeted ads across thousands of apps and now even connected TV. Second, on the publisher side, it helps app owners monetize their ad space by connecting them with the highest paying advertisers in real time. Think of it like a super smart dating app for ads. Axon AI matches advertisers with users who are most likely to convert, and it gets smarter with every transaction.
So they're not making the apps themselves, they're the infrastructure behind the scenes?
Exactly. And they make money primarily through a take rate, a small percentage of every ad transaction that flows through their platform. They also have a subscription analytics tool called Adjust and a mediation platform called Max that helps publishers manage multiple ad networks. Key point, this is a two-sided marketplace. More publishers attract more advertisers, which attracts more publishers. That's the network effect we'll talk about in a minute. And critically, their Q1 2026 filing shows revenue of $1.84 billion, up 59% year over year. This isn't a small player.
Got it. So they're the picks and shovels of mobile app advertising. Now, Sarah, in our research framework, we classify companies into growth phases. Where does AppLovin land?
AppLovin is firmly in phase 3, scale up. Let me walk through the decision tree so viewers understand the logic. Is the company returning significant capital to shareholders? Yes. They bought back $982 million of stock just in Q1 2026. That's a strong signal of confidence. Is operating income consistently positive? Absolutely. They reported $1.44 billion in operating income last quarter, up 71% year over year. Is revenue growth above 20%? Way above. Plus 59% year over year. When you hit all three boxes, profitable, high growth, and returning capital, that's the textbook definition of a scale-up company. This matters because it tells us which metrics to watch and how to think about valuation, which we'll get to.
So phase 3 is the sweet spot. Growing fast, but already profitable. Not a speculative startup, not a slow growth mature company. Got it. Now, what protects AppLovin from competitors? Let's talk Moat.
Great segue. A moat is a sustainable competitive advantage. We evaluate 5 sources, and AppLovin scores well on 3. Switching costs, high. Once an advertiser integrates Axon AI, they've trained it on their historical data. Switching to a competitor means retraining, re-optimizing, and risking performance dips. That's sticky. Network effects, high. This is the big one. More publishers equals more ad inventory equals better data for Axon AI equals better ad performance equals more advertisers equals higher yields for publishers. It's a flywheel. They're now reaching over 1 billion daily active users across their network. Intangible assets, moderate high. Their Axon AI engine, proprietary machine learning models trained on massive data sets, is hard to replicate overnight. They also have patents and brand recognition in mobile gaming ads. Now, two areas are more moderate. They don't have a pure low-cost advantage because they pay approximately 89% of revenue back to publishers as revenue share. And while they're focused on performance ads, competitors like Google and Meta also use AI, so counter-positioning isn't a huge moat yet. Bottom line on Moat, we rate it moderate wide and widening. The AI flywheel is strengthening, but platform risk, like iOS privacy changes, is the key threat to watch.
So the moat is real but not impenetrable. What's driving growth from here? Is the easy money already made?
Not at all. We see three primary growth engines, and they're all green light strong. Number one, Axon AI performance advantage. This is the core. Every quarter, Axon gets smarter. Better ROI for advertisers means they shift more budget to AppLovin. That's share gains and pricing power. In a performance-driven world, results win. Number two, connected TV expansion. This is the new frontier. AppLovin is leveraging its existing AI infrastructure to move beyond mobile apps into streaming TV ads. That's a massive, under-penetrated market. Think of it as the same engine, new highway. Number three, the network effect flywheel. As we discussed, scale begets better data, which begets better AI, which begets more scale. This isn't linear growth. It can be exponential if execution holds. We also see moderate strength drivers, international expansion, upselling existing advertisers on new ad formats, and strategic partnerships like their agency deal with Stagwell. Key takeaway, growth isn't reliant on one trick. It's a portfolio of drivers with AI at the center.
Okay, so the story is compelling. But Sarah, our viewers care about numbers. How do the metrics look for a Phase 3 company like this?
Let's pull up the scorecard. For Phase 3 scale-up companies, we focus on 6 metrics with red/yellow/green thresholds. Revenue growth greater than 20%, AppLovin plus 59%, green, operating margin greater than 15%, AppLovin 78.2%. Green, FCF conversion greater than 20% of revenue. AppLovin 70%, $1.29 billion FCF on $1.84 billion revenue. Green, those three are exceptional. Now, 3 metrics have limited disclosure, so we mark them yellow but not red. Revenue concentration, they don't disclose top customer concentration, but their diversified publisher advertiser base suggests it's not a major risk. R&D investment, 5.1% of revenue seems low, but in absolute terms, $94 million quarterly is meaningful for AI development. Sales efficiency, LTV to CAC isn't disclosed, but 70% FCF margin implies strong efficiency. Overall health assessment, strong. AppLovin is executing the scale-up playbook, growing profitably while reinvesting in moat-widening capabilities. No critical weaknesses flagged.
Strong metrics. Now the million-dollar question, and I mean that literally given the market cap. What's the stock worth? Let's talk valuation.
This is where it gets interesting, Billy Bob. We have 2 lenses. Analyst price consensus, current price approximately $486. Average 12-month target approximately $655. Implied upside approximately plus 35%. Range $340 bear to $860 bull. Zacks rank 3 hold. Key nuance. Analyst agreement is low. Estimates vary by greater than 15%, signaling uncertainty. But the revision trend is positive. 5 of 6 analysts raised estimates in the last 60 days. Simply Wall Street DCF model, fair value estimate, $877. Implied upside, approximately plus 81%. Valuation score, 4 out of 6. Model assumes sustained high growth and margin expansion.
Why the gap?
The DCF model extrapolates AppLovin's current exceptional performance, 59% growth, 78% margins, further into the future. Analyst targets are more conservative, factoring in risks, platform dependency, iOS Android policy changes, competition from Google Meta Unity, and the possibility of multiple compression given APP trades at approximately 30 times forward PE versus the software industry average of approximately 18 times. Key risk flags, high beta 2.37 equals volatile stock. Premium valuation equals less margin for error. Concentration in mobile gaming ads equals sector-specific risk.
So we have a bullish DCF, a moderately bullish analyst consensus, and some real risks. Sarah, bring it home for our viewers. Based on everything we've discussed, Business model, phase, moat, growth drivers, metrics, and valuation. What's the call? Buy, sell, hold, or do nothing.
Here's our methodical conclusion, Billy Bob. If you already own APP, hold. The fundamentals remain strong. Phase 3, execution, widening moat, powerful growth drivers. But given the volatility and premium valuation, this isn't a stock to ignore. Set a mental stop loss or rebalance if it becomes too large a position. If you're looking to buy new, wait for a better entry or scale in gradually. The DCF suggests upside, but analyst consensus is more cautious. With the stock down 28% YTD already, you're not chasing the absolute peak. Consider dollar cost averaging. Buy a small position now and add on further weakness if the growth story remains intact. If you're risk averse or need income, do nothing/avoid. This is a high beta, no dividend growth at a premium stock. There are less volatile ways to participate in digital advertising. One sentence summary. AppLovin is a high quality company in the sweet spot growth phase, but the stock price already reflects a lot of optimism. Patience and position sizing are your friends here.
Powerful stuff, Sarah. So to recap for our viewers, AppLovin is a profitable, high-growth advertising infrastructure company. It has a real widening moat powered by AI and network effects. Growth drivers are multiple and strong. Valuation is the debate. DCF says undervalued. Analysts say fair with risk. Recommendation: hold if you own, scale in cautiously if buying new, avoid if you need stability.
And one last reminder, this is not personalized advice. AppLovin's next earnings report is August 5th. That's a key catalyst to watch. If Axon AI metrics continue to impress, the bullish case strengthens. If growth slows or margins compress, the bear case gains traction.
Perfect. Thank you, Sarah, for that masterclass in methodical analysis. And thank you, our viewers, for joining us live. If you found this helpful, smash that like button, subscribe, and drop your questions in the comments. We read everyone. Until next time, keep building that wealth, and we'll see you on the next Build Wealth Now News. Build Wealth Now News is dedicated to research the businesses behind the stock names. Our research are done with artificial intelligence assistance using the best practices in the industry. Please note that investing carries its own risk, and you should do your own research before committing any stock to your own portfolio. This conversation is for educational and entertainment purposes only.